Let's start with the retail sales number out up 1% year on year for March, an improvement on the numbers that we saw out in February, where there was a contraction of 1.3%. Is this the beginning of much better things in the retail environment, in your opinion?
Yeah, we're starting to come off a very low base at this point, so you will see retail sales figures going up. And I think, you know, if you look at the quarter-on-quarter numbers, that's projecting a much better sort of figure, you know, 3.5% sort of territory. So that indicates that the momentum is starting to build. That's taking the seasonally adjusted figures into account. Having said that, you know, obviously what retail sales are feeding off is lower interest rates, better confidence, those sort of factors coming through. But the employment situation remains weak. So
you know, 171,000 jobs lost over the first quarter, 25.2% unemployment rate.
So that reduces the potential to see, you know, bonanza season ahead of us.
The consumer in trouble as a result of job losses and potentially retrenchments still to come to the fore in South Africa. But perhaps also if we can focus on the debt to disposable income line, sitting around about that 80% level still. Are we going to see that coming down anytime soon, in your opinion?
It will definitely come down as personal disposable income goes up, which we'll obviously see it going up in nominal terms over the next few months and quarters. And at the same time, credit actually lags the cycle. So you will see it coming down quite a bit, probably into the lower 70s. The important one, though, from the consumer right now is more the debt servicing cost ratio, which is down below 8% at the moment. And bear in mind, during the height of the peaking interest rates, we were above 12%, which was devastating for the consumer. Anytime you go above about 11% on that ratio, you're looking at a bit of trouble.
So just reiterating, we're at 8% at the moment.
That's right, yeah. So that's looking a whole lot better. But of course, you know, it's still a vulnerable situation for the consumer because those debt levels, we start in the cycle at much higher levels than we started the previous consumer cycle.
Eric, a moment ago, made the point that we're not an island. We are going to be impacted by what happens offshore. How do you feel the Eurozone is going to impact us, given the fact that we do export 30% of all of our exports to the Eurozone? I know Germany and France are among the bigger of the trading partners, so it's not directly impacted by Greece.
Yeah, you know, trouble in Europe really does spell a lot of trouble for us, particularly, as you said, through manufactured exports and particularly in the motor vehicle sector. And what we've seen, of course, is a big fiscal boost, cash for clunkers type of exercises going on. And after the big dip in motor vehicle exports in the early part of last year, it bounced back nicely in the second half. And now it's sort of like wavering a little bit. And clearly, if Europe goes into another bout of troubles, it spells difficulties for us from that perspective, and particularly through the employment line, which was the unusual aspect in this downturn. So, as you mentioned, I mean, Germany is not really directly affected by what's happening in Greece, but obviously it doesn't help to, overall sentiment actually gets worse and worse as a result of it. And I think generally people expect Europe to actually underperform. So we think that is still very much a constraining factor on our local economy.
And looking at the fact that the rand has strengthened against the euro, that is another element that we need to take into consideration. We know how that dramatically impacts our exporters negatively.
Well, absolutely. I mean, the trade-weighted rand has actually appreciated since the last MPC meeting. So
maybe a case for another interest rate cut. Are you saying that as well, along with Ashraf Ladi?
No, you know, I think that it's quite possible that certainly the downside risks are there, and probably they fairly evenly balanced over the next couple of meetings. But I think for it to happen, it's not for me so much an exchange rate story. We'd really have to have evidence of another slowdown in the global economy, which is going to impact on the local economy very adversely, and consequently the Reserve Bank would then ease.
Last night we were discussing that we could see 8.40 on the euro rand. That would have dire consequences for us, or again, is that an alarmist attitude?
Well, it really puts those exporters that export into Europe under a lot of pressure. There's no question about it. So yes, I mean, it's not the ideal.
Have you put that number into your equations or not? Are you looking for?
Well, it's changing day by day, as you know. So it's. I mean, we are looking for the euro to go closer, you know, towards parity over the next few months, because typically once once these major currencies start moving, they move very quickly and then they settle at a new level. And the question is, what is that new level going to be? Is it going to be 115? Is it going to be 1? Or do we even go back to former sort of levels of 90, which would be which would have major ramifications right throughout the world, not just for South Africa, obviously.